Everyone. I can see a lot of people joining in. Let's just wait for a couple of minutes and we can start promptly with our informational session today with Pau. Okay. I see the numbers rising up. Oh, okay. Let's just begin our webinar for today since it's exact on time. We want to be as punctual as possible. Welcome back, everyone. It's great to see so many familiar names and plenty of new ones too. So, last time we talked about Aussie expat tax residency, how it works, what to watch out for, and the common mistakes that could cost you plenty of dollars. So, if you missed it, don't worry. We're building on that today with something just as important, that is property taxes in Australia, how to make those money numbers work for you and not against you. Pau, could you please share the next slide? Yep, amazing. We'll also have a Q&A session at the end, but we will have something amazing specially lined up for you to make sure that everyone gets their questions answered. More on that later. But before we begin, just a quick disclaimer that all the contents shared today is just for informational purpose and not a financial or tax advice. But for you, it's always best thing to do is chat for with a professional. And luckily, we'll have something very special on that part as well in the later session. So please stay tuned with that on us. Now I could keep talking, but let's be honest, you're here to hear from the real expert. So without any further ado, let me pass it on with the host with a special introduction. So Pau is an expat tax specialist with 10 plus years of experience helping expats and overseas investors with their Australian taxes, covering tax advices to tax return preparations. So Pau, I hope that introduction actually abides by what you've been doing and serving and helping the Aussie expat communities worldwide. So you can take it forward from here. I'll be muted.
Okay. Thank you, Tata. And thank you for everyone attending tonight's webinar. It's Hong Kong time right here. I'm based in Hong Kong. For anyone that you haven't had a chance to speak with, let me just give you again a quick intro about myself and also the company. So what we do here at Odin simply in Texas, look after people living abroad to make sure you can be seen as a non-resident, the topic we mentioned about on last section. You can be seen as a non-resident to protect your overseas income from being taxable. And today we're going to talk about the properties, which is the most common investment vehicles that most expats, PR or foreigner who live abroad and want to get back into the Australian market. This is probably one of the first thing that they think about. And we're going to go over about how does it work in terms of your tax residency, your citizenship status, and how does it impact in terms of the property taxes, like cost of buying, owning the property, and eventually when you sell. What are the different treatments between if you're an Australian, how does it work? If you're a foreigner, how does it work based on where do you live? To some of the key costs on buying the property, stamp duty, the foreign investor reviewed board application fee to the surcharge, some of the surcharge that applies on the foreigner, and a lot of confusion sometimes that even expats thought they would be liable for surcharge. So let's get it right today with these information sections. Eventually, when you are running the property, once you settle, once you're running your own property, either for investments, either for yourself to live in, what are the different taxes, outgoing expenses that to be mindful of, which can also help you to minimize some of your taxes as well. and some of the strategies for you to think about before you go into the property market. You want to make it right from step one to make sure this is a long ongoing plan for you to achieve, and you're going to get something out of it at the end of the day. Okay. So when talking about investing in properties in Australia, I always break it down into three things, three steps. Cost of buying the property, which include upfront costs like stamp duty, FRB, legal, etc. How much you need to bring up to the table to complete a purchase. And this is kind of combined with our other business that we do, Odin Mortgage, in terms of how can we help you to minimize the cost that you need to bring to the table to complete a purchase of property. To likely you only need to bring up 25% to the table. If you can get lending with the bank at 80%, you need to bring in 20% down payment plus average of 5% for stamp duty. It might be maybe a bit higher for foreigner if you want to buy, because there are these additional surcharge and FRB fee you need to pay. Once you settle the property, once we go into the owning stage, the running phase of the property, what are the outgoing expenses that you need to pay, and then depends on whether this is going to be an investment property. If so, how does it work with you on the property tax? What expenses you can claim? How can you minimize some of these taxes like land tax, etc. To eventually, when you are looking to sell, how do you exit and minimize your tax? How do we calculate the capital gains tax? And that one is truly a big topic in different scenarios. So we're gonna leave that section into our next webinar happening next month to truly dive into the capital gains on different scenarios, how you can help to minimize some of these taxes. So when I break it down into, this is similar to the three stages: purchasing, running, and eventually when you sell the property. So the biggest one is always the stamp duty. You need to pay the normal stamp duty for most of expat clients living overseas. You are unlikely to get any of the concession, any of the grant. So you need to come up with roughly that 5% stamp duty to land tax. And just be mindful, the difference between stamp duty is this is one-off. You paid it once, it's gone. You don't need to pay it again in the future. But for land tax, this is a yearly outgoing expenses once you're above the threshold, once you trigger. And in some states, they're becoming harsher and harsher on investors. So you would like to make sure you understand the rules in different states, because every state is different. They vary between different rules and thresholds. To eventually, when you sell, what are the profit that you made, what sort of tax you to pay, depending on the ownership period, what is your residency? This one will come down to the tax and residency. Where do you live? What sort of discount can you get? Is this going to be something you're going to live into in the future, etc.? So again, we're going to focus this one on the next webinar. So when it comes to cost of buying, these are the one that you need to be mindful of. The compulsory one, so the stamp duty, so mandatory stamp duty, the convenza, these are the one that you pretty much cannot get away from. So stamp duty, which stay for a duty to transfer the property in between the ownership from someone to your name, so you need to pay a fee to the government. Every state charge differently, and different rules apply as well. Some of the concessions, some of the exemptions, some of the grants, that depends on, and from time to time, they always bring up some of the promotions, you can call it, to push for new properties that can sell at a discount on the stamp duty. And for convenza, which is like a legal solicitor, you need to appoint a solicitor to help you with the purchase of property, to go over the legal paperwork, make sure the contract is okay, all the terms and rules are acceptable, to help you from reviewing the contract to eventually help you settle the property. And the cost is about 3,000 to 4,500 each, depends on you going with a convenza, usually to be cheaper, but with solicitor, they tend to be a bit more expensive. Some of these are optional in terms of buy agents. If you're doing your research online on say realestate.com, for example, you find the property yourself just online, you don't need to pay for this. but they exist in the way that they tend to be helping people to find the property that they like, and sometimes which is off the market. Some of the off the market property that you couldn't access on realestate.com, for example. And you pay them for negotiating the contract with you. Hopefully, they can give you a discount. But again, this is optional whether you want to use it. Some of our expert clients find it useful because it just help you to take away a lot of these problems, especially when the market was a bit down. There wasn't too much of properties on the market, so they might have access to some of the hidden one, to some of these miscellaneous one, pets, building inspection reports, and mortgage registration fee, insurance, the title transfer. So these are only a couple hundreds on each of them. So they usually come at the time when you find a property you need to settle. Then you need to pay for these, and usually it's coming either coming from the loan amount if you are getting a mortgage from the bank, or you pay it at the end of the settlement. To this last one, FIRB, the full name stands for Foreign Investor Review Board. And these only apply to foreigner. And the definition of foreigner here is purely someone without Australian passport or without Australian PR. Then purely a foreign investor who want to buy a property in Australia, you need to be approved it before you can sign a contract and buy a property to make sure you are a natural person, you are not on any of the lists, and the money that you are bringing to the country is cleaned without any issues. So you need to get approval before you can sign up any contract and buy a property in Australia. Quickly, just some numbers in terms of the stamp duty and the surcharge. I have every state here. So this is the most common one, maybe like in Victoria, in WA, Queensland, and New South Wales. So I won't go too deep into the numbers at each state. I just want to focus in some of these examples when it comes to the surcharge, which again, the surcharge does not apply to Australians, even though you are living overseas. Um, it's more targeting the foreigner who want to buy a property. They need to pay an additional surcharge to get into the market. So average, it's from 7% to 9%. The only state that I want to put a bit more attention to is in New South Wales, especially for if some of our audience are Australian PR living overseas. You haven't get to get a passport in Australia, you are still remain as a permanent resident but living abroad. The rules are completely different in your scenario because in New South Wales, you can say they are one of the least favorable state for PR living overseas because they are going to treat you like a foreigner. Even though you are a PR of Australia, if you're not living in Australia, you would be liable for this 9% stamp duty surcharge on top of the 5%. So you're paying total around like 14% like a foreigner. Compared to Australian citizen, you pay 9% higher. So just be mindful on this point because that sometimes becoming a problem that someone was thinking about buying Sydney, but eventually when they realize that you need to pay a 9% surcharge, they tend to change to other cities if this is a purely investment decision. For the other states, again, the threshold are similar. There wasn't any surcharge in Northern Territory and in Capital Territory. So these are the only two that do not charge a surcharge. So for some foreigner, maybe you want to look into these two states to try to get away from the 7, 8, 9% of surcharge and just normally pay the standard one. But in South Australia, Tasmania, yes, there's another 7 to 8% of surcharge. This one, the Foreign Investor Review Board. Again, this is only applied to foreigner. I still want to put it here just for some of the clarifications, especially you read the news happened, I think 2 weeks ago about banning foreigner to buy existing properties. And I have the rules here, I quoted here. This doesn't apply to, again, Australians living overseas. You are not under the definition of a foreigner. You can still buy existing properties in Australia because you're still holding the Australian passport or PR. This is only limiting again the pure foreign investor. And now, starting from 1st of April, they're gonna also include for some of the temporary resident who are on a temporary visa living in Australia, they can no longer buy existing properties in Australia. This ban will be last for 2 years and it will be up for review for once it expires to see whether they're gonna continue suppress the foreign investor to give more room to the Australians, or maybe there could be a change of policies. But when it comes to this fee, it could be cheap as 4,300. But generally speaking, you are likely to looking at under the knee or near need residential dwelling at about a million or 2 million threshold. So for foreigner, you need to pay 14,700 up to 29,500. That is likely the range that you are looking at if buying new properties in Australia. And then when it comes down to cost of owning a property, once you have settled the purchase of the property, depends if you are going to rent out the property, these are the expenses that you can claim against the property, the rental income. If you are to live into the property, then still some of these expenses might be what you need to come up with out of your pockets. So the basic one comes from the council rates, water rates, land tax. These are charged by your regional council or by the state government in terms of land tax. So this is something you can't get away. Council for water, you have to pay it. It's a service that you're gonna get from your local council. For land tax, again, it's only liable once you are above the threshold of the land tax. Generally speaking, for apartment, they would have a lower land value because you are literally sharing the land with multiple owners. But when it comes down to townhouse or house, you are either own the land outright by yourself or you're sharing with your neighbor. So the land value tends to be higher on a house type of property. Insurance, if you are buying a house, the bank and getting finance, the bank would need you to get insurance for property to secure the bank as well. If you're buying apartments, there will be strata insurance to cover you. But sometimes our clients will also buy the landlord insurance, for example, if they want to protect themselves from rent or from other like thief, other stuff, or damage to the property. Some of these repairs and maintenance, if you are renting out the property, likely there will be ongoing repairs and maintenance that you need to come out of your pocket. And the biggest one is actually the interest that you pay on the mortgage. And it is tax deductible still in Australia with negative gearing that applies. So whatever you pay right now, we are on the high interest rate market. So some people will just utilize the offset account to try to play around with how much interest they want to pay right now under the high rate market environment. But it is deductible against the rental income that you get. This strata I mentioned before, it's similar to insurance that you pay the strata once you settle the property and you pay for the apartments to secure the maintenance of the utilities within the building. To depreciations, this is something new changes as well back then. Now you want to claim full depreciations, it only applies on new properties that you buy. If you're looking to buy second-hand property, you can only claim the building component of the depreciations. So for any fittings and fixtures within the apartment who might be left over from the previous owner, those are no longer deductible. So whatever they have, you can't claim a depreciation on a second-hand property. It's brand new, you probably get something at 10K to 30K, depends on the price level, depends on the fittings and fixtures within the apartments or buildings that you have. To us, our fee is also tax deductible. And just because Australian tax is so complex, and that's why accounting exists in Australia. So, for example, I'm living in Hong Kong. There wasn't something called accountants, tax accountants in Hong Kong for personal tax matters. So, but again, our fee is also deductible against the rental income. I want to again focus on the land tax as well. Maybe a lot of people would have question around this, and some you might be hit if you have a property in Victoria. That if you look at the table here, New South Wales to be a most generous state because all the price points tend to be more expensive anyway in New South Wales. So they give you 1.075 million threshold if your land value, again, this is only looking at the land value of your property, not the total value price point, um, market value of the property itself. We're only looking at the land value of the property. If you're below in New South Wales below 1.075, you don't need to pay anything. You don't need to pay the land tax. You don't need to pay the 1.6%, etc. But if you compare to Victoria, they used to give you 300 or 350, so I can't remember the exact number, but this changed last year. So they drop it down to 50. If you are above 50, then you need to pay a 500 flat fee. So I would say that would now target maybe like 80% of the properties in Victoria, including apartments, that even though you're sharing the land with multiple owners, your entitlement to the land value might still be above the $50,000. And I think that was one of the reasons why the Melbourne market was a bit down in terms of the property market itself. A lot of people are selling because this just hit them off guard that that wasn't expecting to pay any land tax, but just receive a bill. And it feels worse for people who own multiple properties in Victoria as well. The rest are quite similar. Queensland, they give you 600K threshold, WA 300K. One of the one again, New South Wales. Let's come back to New South Wales. Um, they are not that friendly again to PR. For foreigner for sure. This is about the surcharge. You look at the table here. Some of these states, they would charge you a surcharge between 3%, 4%, up to 5%. In WA, they don't. So again, it could be one of the state for foreigner to look into. But this surcharge doesn't apply on Australian. So again, this will come back to citizenship, not about tax residencies. Even though you're living overseas, you must still be exempt from the surcharge if you are a Australian or PR living overseas. But just in New South Wales, the same topic like stamp duty for PRs living overseas, they treat PR like a foreigner. So, and the worst one is the threshold, the 1.075 million threshold doesn't apply on the surcharge. If you have a property for 1 million land value in New South Wales, and you're a PR living overseas, you can get away on the normal land tax because you're still below the threshold, but you wouldn't be able to get away on the surcharge. You need to pay 5% of that, which is $50,000 per year. And I've seen too many in the last couple of years that he bought in early, but because of the rule changes, especially for a couple who one is Australian, one is a non-Australian spouse. They went in joint name. The 50% of the non-Australian spouse right now are being hit with this 5% surcharge that costs them 40, 50K per year. And eventually we just need to work out something else to either sell the property or transfer the title of the property back to the Australian spouse to minimize the land tax. But there will be the stamp duty, also the capital gains issue that would arise as well. Just be mindful. Again, if you are PR or foreigner, you want to look into these states. What is the stamp duty surcharge? What is the land tax surcharge that will apply to you when you own the property? For other states in SA, TAS, and ACT and New Territory, they are fairly similar. Some of them would have a surcharge, not in South Australia, not in Northern Territory. The threshold is quite generous again in South Australia, $732,000. So it could be one of the states that you can look into if you do have a few in other states, maybe one of the options that you can spread out your property investments in different states. So maybe let's come to some of the strategies. Now we talk about the cost of buying and owning the properties. How can we put them into practice on how to save maybe potentially some of the money that you can get? So the biggest one when you go in is about the ownership structure. If you are Australian, I think this might not be a biggest issue to you. The only consideration would just be, should it be just under your name or you want to bring in your Australian partner into the purchase? That depends on a couple of factors, whether one of them will be earning income, or you just want to go 50-50 to make it easy. But if there's one, and that happens a lot to our clients being an expat living overseas, you don't really get to met or married to another Australian living overseas. Sometimes you just get married to a non-Australian in Hong Kong, Singapore, UK, US, Middle East, whatever that might be. So then your partner, being a foreigner, they also want to get into the purchase with you. And how does it work when there's a foreign element in place? So then we can play around with the ownership structure. And one of the concerns a lot of these people will have is, oh, if I'm not on the title of the purchase, how does it affect me in terms of the mortgage, for example? And this is one of the reasons why we combined mortgage and tax into one, because there are still options. If you are a foreigner, you don't want to be on the title, you want to avoid the stamp duty surcharge, there are still lender options that can offer you a mortgage. So we can still go ahead in terms of, like example here, if this is a foreigner, purely foreign ownership, you will be liable for the surcharge at 8% in Queensland, which will cost you $118,000 of stamp duty plus a surcharge. If this is a 50-50, you buy with Australian plus a foreigner, you're gonna save half of it, because what we can do is only the foreigner will be liable for the surcharge on the 50% ownership. And that will be around 40K. So in this scenario, you are an Australian with a foreigner spouse, you want to go in jointly, your stamp duty will be reduced to $78,000. Or we can look into the other way, which is again to put the property purely on the Australian spouse name. So the foreigner spouse will not come into play at all in terms of owning the property. Then we don't need to pay any of the surcharge, that 8% surcharge. The stamp duty you need to pay dropped dramatically down to $38,000. So again, this line back to the point I mentioned. In this structure, there are still banks that can offer you a mortgage. So you probably don't need to worry about if my foreign partner is not on the title, can I still use his or her income to get lending? Because you want to avoid this surcharge. The answer is yes, it is possible that we can go with a structure that you being Australian come on board to own the property, but your partner will come as a co-borrower to assist you with the lending. So lending wouldn't become a problem. So the key takeaway really is, for some, if you are married to a non-Australian, you're thinking of buying property, these are some of the strategies you can play around to minimize the upfront stamp duty and the surcharge. Or some people, last point I have here, some people just feel like I still want to earn a bit of the property just for personal feeling, I guess, like for safety. I just want to earn a property. Then what you can consider as well is just go with 1%, 1% on the foreigner, but the other 99% you can put it under the Australian spouse. So in that way, you still own the title of property. If for worst scenario, you need to sell the property, your Australian partner need to get your consent. If you don't sign the words, the property cannot be sold. So maybe one of the like structure you can consider if this ownership foreigner element becomes an issue. And then down to the negative gearing, it still applies for us, even though we are being overseas as a non-resident for tax purpose. So whatever you make right now, and especially if you're thinking getting a mortgage, which is being the biggest cost of having a property, you can still claim negative gearing on your property. So if you are making a loss, you can still have it. And not you don't need to pay tax, but still it's a requirement for you to submit the return to the tax office to tell them what is the story that you have. I put one thing here for foreign investor, which is the we call it vacancy fee, vacancy tax return. If you are leaving your property empty, not rented out, just keep it empty, you will be liable for this vacancy fee. This doesn't apply to Australians. So for Australian, you don't need to worry about not having the property being rented out. The only state that would charge you a vacancy fee is in Victoria. That applies to any property owners in Victoria. If you have your property leave vacant for more than half year in a tax year, you would be hit with 1% penalty, or which is 1% of the property value. This is only special in Victoria. For any other states, they do not charge a vacancy fee as of yet, as of now. But for foreigner, you need to be mindful. This surcharge, these are vacancy fee applies for any states, any property you buy right now. For Airbnb, that also considered as vacant because it's not a long-term lease. Okay, so a quick example here, if you rent out your property, you're collecting rent from the property at 45K, for example, and your expenses, including the interest, those we mentioned before, the rule of thumb is every dollar that you put on the property would be deductible. So interest, the council rates, water rates, insurance, agent fee, etc., everything, including depreciations. If that comes up to 60K, then that means you're making a loss of 15K. That you don't need to pay tax, first of all, because the tax rate is quite heavy right now for us as people living overseas, because we pay tax on first dollar. And the rate starts from first at 30%. So $1 at 30%, if you make 10K of profit, you need to pay $3,000 to the tax office. If you're making a loss, you don't need to pay tax, and these losses will get accumulated and carried forward to future. They will not expire, it's indefinite. So the occasion that likely you're going to use them is either when you go back to Australia, you're working in Australia again to receive employment income, or when you start to pay down a mortgage, the property becomes positively geared. You start to collect positive rental income. Or when you sell the property, you have a capital gains. These accumulated losses can still be applied to offset any of these income that arrive in the future. So help you to reduce your future tax liability as well. So this is what hopefully negative gearing will be still with us for the foreseeable future. There have been a lot talking about removing it, but so far I don't really see any government that have been trying to do it. Hard to say, it might happen in the future, but for now, we can still apply the negative gearings. And here's an example just to show you what you might be seeing when you submit a return, what the numbers may look like. For example, let's say 1 million property in New South Wales with 80% lendings. You are potentially getting a 45K of rental yield, which is a 4.5% rental yield. And the other expenses, including the council rates, water rates, insurance, agent fee, repairs, maintenance, the biggest one in the mortgage that you pay, interest you pay on the mortgage, depreciations and our fee. So you probably will be in a loss positions just because the rates right now is still high. But hopefully, we're going to see some rate drops in the next 12 months. We had just one happened last week, 0.25%, 25 basis point. We might be seeing another 2 to 3 coming in the next 12 months. So it might be we're going to see something at 5.5% by the end of the year. If that happens, obviously your interest will come down as well. It would help you from a cash flow perspective, but at the same time, you will claim a lot less losses in your tax return. Again, this number will just get carried forward to future. You got 15,000 this year, another 14,000 next year, another 13, 10, whatever. Those numbers will just get add up and to carry forward to future when you can use it. Another strategy, which is from a land tax perspective, we mentioned about it could be hefty if you are not paying attention to the investment strategies. If you just go ahead with investing all your properties into one state, you could be seeing a huge land tax bill because how they look into it is they look at within that particular states, how many properties do you have? What is your aggregated land value for all the properties that you own within the states? So if you we have an example here, if let's say you got 2 properties already in New South Wales, how can you minimize this is by if you think about like in other properties. If again you buy in New South Wales just because you love Sydney, for example, you just don't want to look into other states, which is okay, but just be mindful of the costs if you are going ahead with that. It can increase your land tax bill from 6,900 to 14,900 if the land value increase from 1.5 mil to 2 million, for example, in this scenario, that you simply just add one more property to your portfolio that triggers a higher land tax that you need to pay. what you might want to think of is for this 1 million third property, 1 million purchase, could you be able to invest into other states if this is purely for investment decision? Maybe there's a better opportunity in other states, and also the land tax can help you to minimize $8,000 here. So, for example, if I buy into Queensland, they give me a $6,000 threshold in land value. This property probably only worth the land will only be worth 500K, which means I'm still below the threshold. I don't need to pay the land tax in Queensland. I can avoid paying more in New South Wales. I can avoid paying in Queensland. So the saving I have here is $8,000 per year. And hopefully your land value will get increased in value because I hope everyone is making a good investment decisions. So if that happens, then you're just gonna pay more and more land tax. If they increase the rate as well, potentially you probably wouldn't be able to catch up on the growth of the property, and also in default out a lot of expenses on your side. Okay. And probably just one last one before we wrap up and go to maybe some of Q&A sections. I can see people are asking questions. So this is one of the most common questions also been asked a lot, whether people should be considering buying under their personal name or using a trust. And the quick answer to most of our clients who are being expat or foreigner living overseas, I would say 90% maybe for our clients are buying under their personal names. Maybe the other like 10%, maybe 15% will be using a trust. And the reason behind this is again kind of combined with the mortgage as well, because if you need a mortgage, just because of the lending policies are quite different when it comes to foreign income applications. Not a lot of the banks would do trust lending for foreign income. There are still maybe like 10, 15 who would do foreign income when it comes to individual names, but it will narrow down to maybe like 3 to 5 when it comes to trust. And usually these lenders are harsh in terms of the weight, how they assess your overseas income. And that's one of the biggest reasons why a lot of people wouldn't be able to buy under a trust. And maybe another benefit is you don't get that much of benefit compared to people in Australia. So when it comes to buying under personal name, it tends to be lower cost because you don't have to pay for any other stuff, just your personal tax return, the cost you pay for having the property under your name. And it's easy to handle. You don't need to worry about another entity. And it opened up the more lender options, like I said. But the downside for that, I guess, is you couldn't be able to distribute the income. But when it comes to expat or foreigner buying a property with a mortgage, there are unlikely any income you're gonna be able to distribute anyway in the beginning of a couple of years, because you are likely to be in a loss positions that you will be making a loss. There wouldn't be any income to be distributed. And that wouldn't provide you any access protections. If you're running business, and the business fell, then the debtor could come to you to look at your personal stuff. If that becomes a liability, you need to pay back and use the property as a repayment to clean up your debts on other investments. But you also have access to tax benefits to claim the negative gearing and to be keep these losses under your name. So in example, if you're thinking of going back to Australia in the long run, these losses that you have accumulated while you're living overseas can now be used to offset the employment income. You're gonna get maybe the first 1 year, 2 year completely refunded on the PAYG withholding that you paid and employment. So you're gonna get a huge refund from the tax office. And these tend to be work pretty well for like a short to medium term planning. If you're purely coming from an investment perspective, hold it for a few years, 5, 10 years, and you're likely to sell and buy something you're gonna live into when you come back to Australia. So it works pretty well in the personal names. But on the other side, using a trust, it gives you a bit of protections in terms of it's a separate entity. Anything happen to yourself personally, this is something away from you, so you wouldn't be affected for any properties that own under a trust. There'll be additional costs for running. You need to pay more to run the trust, the compliance issues, the tax returns, etc. It's usually harder to handle. You need to have a trustee to run the trust on behalf of all the beneficiaries, make sure it's done equally and fair to everyone. So more paperwork, more attention you need to put into. And it has less lender, like I mentioned, only a few lender who can do trust lendings, but it give you the opportunity to distribute the income to someone who might be working, for example, your parents not working in Australia, they have the threshold, the $18,000 threshold. You can be distributing income to them and they pay no tax compared to you to collect the income and you might be facing a 45% tax bill on those income. But again, when it comes to expat scenario, you are based overseas. There shouldn't be any employment income coming in Australia for you, and the property is likely to be in a loss position. So there wouldn't be any income to be distributed as well. And again, if you think a longer term, you do have a plan, you're pretty sure that I'm going to be here for 5 years and eventually I'm going to return to Australia. My kids are going to grow up. My parents are going to retire. I do know there are a few people that can come as a beneficiary. I can distribute some of this income to them. Then yeah, trust will work pretty well for you. If you really know what you're going to do, then we can consider looking at trust to see the lending, if you need finance, what are the lender options that you got, whether this can be done. But just on a reality that our clients that we've been helping, yeah, most people would just go with personal for peace of mind, easy process. And the most important one is really just open up more options when it comes to finance. Okay, so I'm gonna wrap up here. Maybe we can come back to some of the Q&A questions. I'm gonna pass back to the Tata to let us run some questions Q&A.
Great. Thank you so much, Pau. I really feel like it was amazing information and we got a lot of questions. So I'll just jump right through it, starting from the first question we received from Peng. How to avoid paying land taxes? And is land tax deductible from income tax?
Yeah, land tax is deductible. So if you're paying, yes, we can claim it. How to avoid it? Like I said, with upfront planning, to make sure you understand what are the rules at each state, and also kind of depending on your citizenship. Are you an Australian? Would you be exposed to the surcharge, or are you a foreigner or PR living overseas? Then maybe you want to look at right now. I don't want to buy in a particular state. I don't want to be hit with a surcharge. That would be a more personal questions on depends on your again your personal situation, how to best structure yourself. Again, maybe depending on how many properties that you already have in each states, that also play a significant role into what sort of land value that you might have in a particular states.
Perfect. I'll just go random. Um, okay. Land tax minimization, gross up land value by me and spouse total portfolio by Eric. Like it must be about how we could minimize your tax, land tax.
That every different states has different rules. In some state, they do an individual assessment, land tax assessment, and they also do a joint assessment. So in that way, you probably still need to pay land tax, depending on the total land value. But in some states, in Queensland, for example, they give you 600K threshold per person. So if let's say you own a property at 1 million, so with a 1 million land tax value, so land value in Queensland. If you're buying the property under your name, you're gonna have 1 million. So you need to pay the 600K. So you'll be above the threshold of the 400K, you need to pay land tax on the 400K. But if you buy as a joint name with your partner, who also be an Australian, in Queensland, it's not that strict. Just go with someone else. They also have 600K of threshold. So in that way, you can have a combined 1.2 million threshold. So that property from being taxable for land tax, if buying a single name, become a non-taxable if we go as joint.
Okay.
And again,
Uh,
different states have different rules, so we need to again look at which states that are you looking into.
Definitely. Moving on to Joseph. If properties in Victoria is jointly owned by husband and spouse, considering the land tax, I consider to transfer title to either husband or spouse as a gift. Does it involve stamp duty payment?
It will if we are trying to transfer the property. to the other partner. Depends on some of the circumstances. If you're in Australia living in Kuwait, then maybe we can get an exemption on the transfer if it is a spousal transfer. But if you're living overseas, this is treated as an investment property for now. You would need to pay the stamp duty. You need to pay the capital gains. You need to pay the capital gains on you gifting, say, your 50% to your partner. Your partner to take over the 50%, they need to pay the stamp duty as well. So it could be quite costly. And again, we need to run the numbers to see whether transferring to kind of save some of the land tax doesn't make sense when you compare the additional cost that it may bring into.
Okay. Another would be an anonymous attendee giving us a question on, does the 50-50 ownership structure apply only if you're 50-50 tenants in common or joint tenants?
The ownership in terms of tenants in common or joint tenancy doesn't really matter too much because what we are looking at is about because the difference between tenants in common and joint tenant, it's more about what if the other half pass away. If this is a joint tenant, then simply the property will get transferred to the other surviving spouse, for example. If this is a tenant in common, then they would need to look at the will for the person, right? What about that 50% ownership? Are they going to pass to someone else or what happens? So that's more coming from that angle in terms of whether you want to go in terms of tenants in common or joint tenant. It happens a lot if it's a partner, they just go joint tenant, but if you're buying with a friend or family, then you might want to choose in terms of tenants in common because you want to protect your 50% ownerships in the future. But when it comes to tax, it wouldn't have much difference. It's the same cost that you would pay.
Perfect. So since we're in the ownership structure itself, I have one more question from another anonymous attendee. Is in the 1:99 ownership structure, how much stamp charge surcharge would apply? Sorry.
So let me use an example, let's say in New South Wales, right? Let's say a 1 million property that you're looking to buy. If you go 50-50, your 50%, which is 500K, we need to pay a 5% surcharge, which is $25,000. If we go one in 99 ownership, then your ownership is only the that $10,000. You only pay 5% of that. It's only a couple hundreds that you need to pay. So that's why I was talking about, yes, it can help you in terms of reducing a huge bill that in terms of the surcharges, but you can still have your name on the property to kind of protect yourself that you have at least hold a bit of it. Feels better.
Perfect. We have a question on, what is the inheritance tax if the property is transferred to children, Australian nationals, by Surya?
Yeah. So in Australia, we do not have inheritance tax. So at the time when someone take over your property, depends on will or whatever that might be, the person who are to inherit the property doesn't need to pay any tax. Maybe only a couple hundreds for paperwork to do the transfer, etc. The tax will come in when they eventually sell the property, when they have the capital gains. Even though there's no inheritance in Australia, they might still inherit your tax liability on that property. If you, during your ownership, you're liable for capital gains tax, they would also inheriting that liability. So when they sell, they also need to consider what sort of tax you might have to pay, and they would pay for you.
All right. Um, we have another question on, is depreciation assessment helpful every year, or can I just do prior to sale of the property?
Usually for depreciation, we're going to claim it every year because that's one of the items they can claim to offset the rent to income and help you to accumulate bigger losses. Um, when you settle a property, you can ask around like these depreciation companies. One, depending on the type of property that you buy, are they brand new? If brand new, definitely worth to get a report, which the report will tell you for the next 40 years how much you can claim for every year. If this is a second-hand property, but considered new, might still be worth to get a report because you might still have, like, say, 20 years of depreciation that you can claim. But if this is tend to be like fairly old, more than 40 years, and there wasn't much of renovation done to the property, maybe you can ignore the topic of getting a report because there are unlikely to be anything that you can claim. But yes, we will likely, I will advise you to claim everything on a yearly basis rather than kind of ignore it.
There are a lot on Victorian vacancy fees and vacant taxes, so I'll just pick one out of it.
Yeah.
It's their understanding that the new Victorian vacant property tax does apply to Australians who are non-resident. Can you please confirm?
So could you repeat the question again? I was looking at one of the question. I got distracted. Sorry.
No worries. So it's my understanding the new Victorian vacant property tax does apply to Australians who are non-residents. Can you please
Correct.
confirm that?
Yes. So that was what I was talking about. Only in Victoria, this vacancy tax applies on everyone. So for the other one that was talking about the foreigner one, that applied on all states, but that only apply on foreigner who is non-Australian and who is paying for the FIRB. So, but in Victoria, they target all the property owners in Victoria. If your property is not being used for more than 183 days in a year, it could be rented out, it could be your family or friends who are using it, but at least someone is using it. How they check it is they simply look at maybe the utilities, the usage of your water usage, your utility bill to see if anyone's occupying the property. If you leave it empty for more than half a year in a year, and they check it and they find out, then yes, you'll be liable for that 1% of the property value. If it's worth $1 million property, you need to pay $10,000 vacancy to the government. And yes, that applies to everyone, every property owners in Victoria.
Okay. So I can see the time's running out. So I'll just pick one last question, which would be on, okay, by Laura. Can you buy or transfer a property to a minor child?
That would create a few problems to a minor. It can be done. It doesn't require like a minor cannot hold a property, but there will need to have administrations on who will be looking after for the benefit of the minor. Tax payable is literally the same in terms of cost of buying, maybe a bit higher. But if this is related to investment property, letting the minor to receive the rental income, that could become a big problem because for minor, they have only a couple $100 of threshold. Once you're about 500-ish, you will need to pay 45% tax. So that could become a heavy tax if this is for like investment properties.
Okay. Thank you so much, Pau. I can see that the time is running out and we have a couple of things to discuss at the later phases as well. So I'll just share my screen quickly because I have an interesting announcement. We have an interesting announcement to make, I would say. All right. Can everyone see? Okay, Pau, can you see my screen?
Yep.
Okay. So last time as well, we had the question answer session and it was an absolute hit. We had amazing number of questions flowing throughout and like today. And while we tried to cover a lot of them in depth, like today, but there were so many great ones that were left unanswered. And that was something interesting to us in some sense because we had over 80 attendees who were with us booking a one-on-one consult with Pau after the webinar and filing their tax lodgements with us. So this time, we wanted to do things a bit better. So instead of leaving your questions unanswered, we were just feeling that maybe we could give something interesting to all the attendees that we have today. So, Pau, do you want to share the exciting news?
Yep. So, for anyone, if I haven't had a chance to answer any of your questions that you post here, or you want to discuss your personal tax situation, feel free. I'm offering this free consultation for you. Usually we charge for $100. But I'm happy to do for free. If you want to just scan the QR code here and book a time with us, um, we can go over your personal situation, make sure if some of your questions are not being answered during this section, we can come and look at your personal to see anything we can help you to make sure you are doing the right thing declaring, and if you have any outstanding returns, we can help you catch up on those as well.
Perfect. So I could see a lot of questions on CGT, the capital gains tax, and that brings me to the next webinar. Pao, would you want to run through what we are going to discuss in the next webinar so that we can keep everyone on their feet?
Yeah. So again, capital gains being the one of the biggest topic, and why you want to invest because you want to make profit out of the investment properties, but capital gains could be very difficult in the way that it could cost you a lot. And we were gonna discuss a few things about how it works, for you to understand the rules and everything, and how potentially your tax residency will affect you, for the time being when you're being overseas compared to the time when you go back to Australia in the future. And what are the mistakes that we have seen a lot? Again, they relate back to the ownership and how you structure it, to how we can help you with some of the strategies to minimize the capital gains tax. So we're going to discover more on the next webinar, which is happening in roughly same time, next end of next month. We're going to send out the email for you to invite you to the next one, and look forward to see you there.
Perfect. Thank you so much, Pau. I still can see the question answer buttons going up. So don't be disheartened if your questions are not answered. We have a free consultation with Pau, which is a 30-minute slot that you can book. There's a link on the chat that you can fill in. And like Pau said, there's still a continuation to this webinar series, and we'll be sending out emailed about the more information on the next webinar, when's it happening, and how you can register. So hope to see you there as well, everyone. That's all for today. Thank you so much, everyone, for joining us, and see you next month.
All right. Thank you,
Bye bye.
guys. Have a good
Thank
night.
you, everyone.
Cheers.
Thanks, Pao.
Bye.